Good morning, everybody, and welcome to our August IFRS and Corporate Reporting webinar. Now, for August, we've scheduled a webinar on exploring the operating and financial review, and we talk about it as the OFR. And we're doing a comprehensive examination today on why we're preparing it, what should be in there, and we're looking at some regulatory guidance from ASIC and some findings and focus areas from ASIC. So we do hope you enjoy this webinar and you find it useful. We know that many of our clients, and those clients in Australia with 30 June year ends, will in the month of August, potentially September, be looking at their OFR, finalizing their OFR. So that's why we scheduled it for August. So welcome to this month's webinar. As always, or usually I do these webinars with Kevin Frobus. However, Kevin is currently on annual leave for 2 weeks. So we hope he enjoy a wonderful time away with his family, and he'll be back next month. So it's only me today. And we would like to begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. And in Melbourne, I'm on the land of the Wurundjeri people of the Kulin Nation. And we extend that respect to Aboriginal and Torres Strait Islander peoples here today. As you know, we've got these monthly IFRS and corporate reporting webinars, and we're already in the 8th one for this year, in our 8th year of running these IFRS and corporate reporting webinars at BDO. You can see next month, we look at common disclosure mistakes. As entities are finalizing financials, just make sure to avoid these disclosure mistakes. In October, we look at share-based payments, which continue to be problematic. In November, we've got our normal update to get entities ready for 31 December reporting. And then in December, we look at a new accounting standard, IFRS 18, presentation and disclosure in financial statements. So you would know it's been a number of years since we had a new accounting standard, a new IFRS accounting standard, but we've got IFRS 18 and we'll talk about that one in December. If we look at our sustainability monthly webinars, again, running up to the 8th one for the year next year, 3rd year of running these, and next month we'll be looking at using climate-related scenario analysis to assess climate resilience. Now in July, we looked at assessing climate-related risks and opportunities, and now we do the next step, looking at scenario analysis. And for the rest of the year, we focus on all those aspects captured within IFRS S2, which we expect to become mandatory very soon. It's still on the agenda to be discussed in Parliament. This morning we had a look. It's agenda item number 6. It's been there for a while, so we're hoping it gets discussed and approved within the next few weeks. So our focus for sustainability is getting ready for mandatory climate reporting, looking at IFRS S2. By the way, the AASB has indicated that they're planning to issue the Australian version of IFRS S2 at the end of August. So hopefully we get the Australian version of IFRS S2, the Treasury regulation, more or less at the same time, and shortly after we expect to see the new auditing standard ASIC 5000 as well. So it's all happening towards the end of this year. So today, our agenda, we're looking at why do we prepare an OFR, operating and financial review? What do we include in the OFR? Why is this OFR so important? Presenting the OFR, preparing the OFR. We look at operations and financial position. We look at business strategies and prospects for future financial years. We do look at the unreasonable prejudice exemption. And finally, we also touch on non-IFRS information. Again, why are we looking at the OFR? Really important that the OFR to be included where entities finalize their annual report. Another reason is ASIC has recently said that the OFR or provide guidance and said there's a focus on the OFR. And one of the things they flagged to go in the OFR is a disclosure of climate-related risks and opportunities. So there's even a link here in the OFR with sustainability. So it's not just about IFRS information, but also potentially IFRS S2 information. So currently, the focus is on the TCFD recommendations in the OFR, and in future it will be IFRS S2, and it will move from the OFR into a separate sustainability report. So let's get started. So why an OFR? Where does it come from? So it's all outlined in the Corporations Act, in Chapter 2M of the Corporations Act, in Section 2951, when they talk about the content of an annual financial report. It says our annual financial report consists of your financial statements, notes to the financial statements, the new document, consolidated entity disclosure statement. For the very first time, we'll see that for 30 June 2024 year ends for public companies only, and we discussed it in a previous webinar. And then we also have a director's declaration about financial statements and notes. So that's what Section 2951 requires. However, if you then go on to Section 298, it talks about that your annual report must also include a director's report. So in this director's report, they say that in Section 299, there's certain general information that have to be included in the director's report by all entities. If you're a listed entity, you also have to include information in Section 299 capital A. In addition to that, there's specific information that needs to be disclosed, and that's outlined in Section 300. So listed companies have to comply with Section 300 capital A. Companies limited by guarantee have to comply with Section 300 capital B, and registrable superannuation entities have to apply with Section 300C. So you can see all of these sections work together around what will have to be included mandatorily in your annual report. Certain parts are mandated for the financial report, other parts are in the director's report together in the annual report. And we know when that final legislation comes through, hopefully within the next few weeks, there will be some changes to this to also add a mandatory sustainability report. It's not there yet. So why an OFR? So again, what we've got here is, as I've said earlier, Section 299 of the Corps Act applies to all entities. And it says that your annual director's report must contain a review of operations during the year, of the entity reported on, and the results of those operations. So often this is quite a brief discussion, but this has to be done by all entities. Then we know in Section 299 capital A, this is the additional information that's specifically required for listed entities. The annual director's report for a financial year must also contain information members would reasonably require to make an informed assessment of the following. So operations of the entity or the consolidated entity, the financial position of the entity or consolidated entity, as well as business strategies and prospects for future financial years of the entity, or if it's a consolidated entity. So very important that listed entities have to look at this additional information. So again, you see operations of the entity, financial position, but in particular strategies, prospects about the future. So a clear focus there. So please be aware that there's certain information around operations that's required by all entities. And then there's very specific additional information that's expanding on that for listed entities. Important, you can omit material that would otherwise be included uh, if it's likely to result in unreasonable prejudice to the entity. So right at the end of the section, I'll come back to what is unreasonable prejudice to the entity. So those are the requirements in the Corporations Act. That's why we're doing it. So an entity is preparing a financial report or an annual report in accordance to Part 2M of the Corporations Act. An OFR and a discussion of her operations is what the entity has to do. So what do we include in the OFR? Now, ASIC actually issued a regulatory guide, Regulatory Guide 247, and there's a link to that guide. And on the right-hand side, I've got an extract from the contents page where they discuss what should be included in this operating and financial review. And they've got 5 sections. So it's an overview. In this regulatory guide, they provide about an overview of what is an OFR, why is it important, etc. And we'll work through a lot of that today. Then they talk about preparing an OFR. So what's the information about your business, your narrative, your analysis, and what's the information reasonably required by shareholders? Then in the 3rd section, they talk about operations and financial position. And included in there is a discussion of non-IFRS financial information. There's also examples of disclosure, and we'll look at some of that as well a bit later. In the 4th section, they look at business strategies and prospects for future financial years. So what do we mean about that? And again, they talk about the use of unreasonable prejudice exemption. And finally, how do you present the narrative and analysis? So really good guide, around 30 pages to give you guidance around the operating and financial review. It's an important document because it's published by ASIC, number 1. ASIC has the OFR as a focus area, number 2. We've seen a lot of times that entities have not really complied with all the requirements of a regulatory guide 247. So important to have a look at that while you're busy finalizing your reports. So it's important that this regulatory guide assists directors and preparers to comply with Section 299 capital A, and also it promotes better communication of useful and meaningful information to shareholders. Ultimately, conceptually, that's what we're trying to do here. Communicate useful, meaningful information to shareholders to enhance their understanding and decision making. So why is this OFR so important? Why this focus on the OFR? So the regulatory guide outlines, in particular in paragraph 6, that an OFR is an important document in meeting the information needs of shareholders. So while your financial report provides useful information about financial positioning and performance, it will rarely provide all of the information needed to readily assess the entity's financial position and maybe to appreciate all the underlying reasons for the entity's results. The other thing is it will also provide little, if any, information about business strategies and prospects relevant to future financial performance. And I think that last sentence of Regulatory Guide 247, paragraph 6 is incredibly important. We know that the financial statement of financial position and the financial statements look at an historical perspective. But if we want to get some idea about business strategies and prospects, about future potential performance, that's what we could potentially see in the OFR. I think important, the OFR promotes accountability of boards, provides information required for shareholders to determine whether to continue to invest in the entity. So it's useful, meaningful information to enhance a shareholder's ability to make decisions whether they want to continue to invest in this entity or not. So you'll see on the right-hand side of the slide, I've also put in an extract from RG 247 paragraph 8, talking about some additional benefits of why the OFR is so important. So presenting the OFR. I think the biggest issue with OFRs is that often these OFRs are very brief and boilerplate, and the same from year to year. So the whole idea articulated in Regulatory Guide 247 is we do not want boilerplate disclosures. The disclosures in the OFR must reflect the entity's individual circumstances and the business environment in which it operates. So every entity is different, and this is an opportunity to articulate that. Every entity in their industry, in their sector, might be subject to different things that they want to report on. And their business environment changes from year to year. So we've been through COVID periods, we've had high inflation, we've had low interest rates, we now have higher interest rates. So that business environment changes from year to year, and therefore one would expect the disclosure in the OFR to change from year to year. And we wouldn't expect the OFR disclosure of a number of entities to be exactly the same or very similar. So if we want to focus on enhancing shareholders' understanding and why they should stay invested in the entity, that's what we would do. Then, if we'll have proper disclosure in the OFR. If you look at the level of detail, ASIC does not expect the same level of detail as a prospectus or a product disclosure statement or PDS, although they often use similar wording in their requirements. The scope and the depth of information for an OFR is considerably less than a prospective or a PDS, because an OFR is provided to shareholders who already have some level of familiarity with the entity. They might have been on a journey for a number of years. Again, the OFR is designed to be read in conjunction with the financial report. So it's not a completely separate prospectus or PDS. You've got your financial report, you've got the OFR, they read, or they should be read together. The readers often are quite familiar already with the entity, and also it provides information about the entity that is subject to share trading and continuous and periodic disclosure obligations. So please note that the fact that you've had market announcements under your continuous disclosure obligations is not a substitute for doing a proper OFR under Section 299 capital A either. So really important to provide this information, not have it just boilerplate, but have it applicable to your organization for this particular year. No boilerplate. Additional information, it should be complementary and consistent. So those are the key things. It provides narrative disclosures explaining segments of the financial report, for example, the segment report. The comments on prospects and the future should be consistent with the assumptions that's used in the financial report. So we would have made some assumptions, or you would have made some assumptions around going concern, around impairment, and you would have disclosed those assumptions as part of your financial report. So now the comments in the OFR have to be consistent with that again. And it must be consistent with information in other documents. So the key thing is all of this information, the annual report, continuous disclosure obligations, the OFR, all this information are going to shareholders. It's going to the broader market to enhance their understanding. So it should be consistent messaging. A next point is the OFR should be balanced and unambiguous. Big word for me. English is not my first language, a big word, I can't say it again. Only make statements about the future if we've got reasonable grounds around that. So it has to be balanced, unambiguous. From a sustainability perspective, we would say don't make statements in the OFR that could result in greenwashing. So similar, no selective disclosure. So no cherry picking of only disclosing the good news. It has to have good news and bad news should have equal prominence. Now, this is very similar to what we see around sustainability. It should be clear, concise, and an effective presentation. So use plain language, explain complex information, and present it in a logical manner. So these are some of the guidelines around what the expectation is in the OFR. So where do we include the OFR? Now, all the information that's required by Section 299 capital A must be included in the body of the OFR. So it has to be a single self-contained section. And then you cannot incorporate other information or by referring to documents outside the financial report. So, everything has to be in this one single self-contained section. You cannot rely on information that was previously disclosed to the market as part of continuous disclosure, and I've said that before. So what's quite interesting is the OFR is a one-stop shop for shareholder information. So really important to try and focus on that. So you can see that the OFR is something that we don't often talk about. We do a lot of training on IFRS accounting standards. We've been talking a lot about sustainability and IFRS S1, S2, TCFD recommendations. But the OFR is a critical part of that communication exercise to shareholders. It's actually a one-stop shop for information about business strategies and future prospects. So when we look at preparing the OFR, the OFR provides context to financial information in the financial report. So it provides an overview to enable shareholders to understand the entity's business performance during the year, because remember, our financial report is a historical perspective. So why did that end up being our performance? And factors that underpin or underlie the results in the financial position for the financial report. So you can add some explanation. The focus in the OFR is different to continuous disclosure because the OFR provides a summary of a number of things. The OFR provides a summary of key information about operations and financial position. It highlights, it summarizes aspects of key information from past continuous disclosure as well. It also includes a summary of the analysis of key developments throughout the period. So there's been a number of things during the year. Let's summarize everything that happened during the year. And very importantly, it provides an overview of the entity's future prospects. And I think that's where the climate aspect also comes in. It looks at future climate-related risks and opportunities, and future business risks, which include climate risks and opportunities. A narrative and an analysis is required. The information should not be misleading. And then the other thing that's important to note, that information in the OFR is not audited. It's not captured within the official audit opinion over the financial statements. However, because the OFR is presented in the same report as the audited financial statements, the auditors will read it and they must satisfy themselves that there's consistency between the audited financial statements that they've expressed an opinion on and the information in the OFR. And that's all discussed in ASA 720, the auditor's responsibilities relating to other information. So this is important. If we bring it back to climate again, if you include the requirements of the TCFD recommendations in the OFR while we are waiting for mandatory sustainability reporting, which is expected in 30 June 2026. So while we are waiting for that, and you include TCFD recommendations in the OFR, it's not subject to audit as such. However, the auditor will read it and review it and satisfy themselves that there's no inconsistency. So once we've got the mandated climate reporting in a separate sustainability report in accordance with IFRS S2, there will also be mandated assurance over those. If you look at the operations and financial position, the section 299 capital A talks about additional information for listed entities. And they say the annual director's report for a financial year must also contain information members would reasonably require to make an informed assessment of the operations of the entity and the financial position of the entity. So that is somewhat of a looking back to the past. What happened around operations that resulted, that led to our results? What happened in our operations that led to this financial position in our statement of financial position or the balance sheet? And that's what we're talking about in this section. We'll look separately at business strategies and prospects for future financial years of the entity. And remember, these requirements apply to companies, registered schemes, and disclosing entities. So if you look at that, that first part, the operations, what are the kind of things that entities should disclose around their operations? Clients often say to us, here's the regulatory guide, we know we have to put in an OFR, just don't know what to put in. So some of the things you have to put in is key features of the entity's business model. So for example, how the entity makes money, generates income, or capital growth for shareholders. So, how do we make money? What's our purpose? How do we try and make money? What's our key business activities? And if you look at our business model, how do we make money? How do we generate income? How do we generate capital growth? And how do we achieve our objectives? Then there are some key dependencies. Do we have important contracts? Do we have major customers? Do we only have 5 key customers? That is something to put in an OFR. So what are some of the key dependencies within our business? Because those key dependencies would flag potential risks. Also, information around the significance of particular operating segments. Again, we've got operating segments in compliance with IFRS 8, but now we can add some flavor around the significance of certain ones. We look at the underlying drivers of our results, also look at key developments, significant changes during the year, significant factors that affected our results. Why are our results good this year? Why have they been bad? Explain the business model and how it affects the operations. What are the results of key operating segments, especially those significant ones? And discuss major components of the overall results. What's important to note, and we've put it at the bottom here, is please pay attention to non-IFRS information that's used in the OFR. We know if we start to use non-IFRS information, and we'll get to it a bit later, there's some rules around non-IFRS information has to be reconciled back to IFRS information, should not be presented with more prominence than IFRS information, etc. But this is an opportunity to add more flavor, explain, and shareholders can hear the full picture if you want to supplement what's in your financial report. So some of the things that one should look at when we explain these results and drivers of results, some of the things to look at is look at total income and segment income, including looking at income or segment income from new businesses, new products, new markets, Maybe there's the impact of a new competitor. Maybe we had acquisitions. Maybe we had discontinued operations. Maybe there were changes in exchange rates. Maybe we changed our hedging policies. There could have been changes in economic and market conditions. There could have been changes in accounting policy. So these are some of the things that we could refer to in trying to explain our results or the drivers of those results. Again, if you look at, that's the income side. If you look at the expense side, you would say maybe we talk about reasons for impairment losses, reasons that we've got restructuring costs, reasons that we've got significant changes in borrowings. Maybe there's been significant changes in borrowing rates. So these are just some of the examples of the things that you want to flag in the OFR as drivers for the results that you've reported in the financial statements. Again, please pay attention to non-IFRS information. And there's a separate regulatory guide looking at that. In the regulatory guide, and these are some extracts from the guide, they do provide some examples. So for example, on the left-hand side, they say, this is an example of a disclosure that is likely to be inadequate. So let's look at it. It says, the company manufactures widgets in Australia with customers in both Australia and in China. That's it. Disclosure of operations, that's it. The comment from ASIC is, there is a lack of detail about what the company does, just manufactures widgets. The market in which it operates, it's just broadly saying Australia and China, its position in the market, any key dependencies, suppliers, customers, contracts, and major events during the year. So it doesn't address any of that. So then on the right-hand side, they provide example of potential better disclosure with some level of detail that's more likely to be appropriate. So for the same entity, it could be a company is a manufacturer of technology equipment producing two types of widgets, models A and B. Its manufacturing operations are based entirely in Australia, but it distributes its products both in Australia, 5%, and overseas, 95%, mostly in China. And then they link you to the operating segment for more details about the financial performance of key operations. Then they talk in the next paragraph, the company is a key participant in its market, holding a market share of approximately 30%. With a very diverse customer base, the company does not have any dependencies on key customers. In May, the company announced that it has been the target of an unsolicited takeover offer. The directors believe that this offer significantly undervalued the company. The offer caused some disruption, diverting management time from daily operations. And as a result, the company incurred one-off cost of approximately $225,000 in relation to the offer. The offer has since been withdrawn. So it's a summary of key things happening during the year, and it's explaining this additional cost. As part of our cost reduction program, it was necessary to reduce production staff numbers this year from 80 to 70. Redundancy payments totally $725,000 explain the higher employee benefits expenses this year. So you can see there are additional information, so much more than just the bland statement on the left. Now you might say, Aletta, surely people don't have a one sentence. I can tell you there's a number of financial statements that have disclosures more similar to the one on the left than the one on the right. And that's why ASIC is currently focusing on the OFR. It's been a focus area for a number of years, and they're slowly addressing this. So it's a really important area to have a look at. The next example to have a look at is on the left-hand side. Profit has increased by 10% this year compared with last year. So yeah, everybody can look at the financials and see profit has increased by 10%. It's kind of stating the obvious. But what we're looking for in the OFR is some analysis of the underlying drivers of this profit increase. So profit has increased by 10% this year. So a better example on the right-hand side. Profit has an increase by 10% this year compared with last year, primarily due to a 15% increase in the volume of sales in China. A strong focus on reducing manufacturing costs, resulting in these costs being 8% lower than last year. This is in line with expectations set out in last year's OFR. Then they go on. Underpinning the increase in sales was a strong marketing campaign. So you can see marketing spending was 10% higher than last year, and an increase in our sales force in China by 5%. Profit margins were about 10% lower this year than last year due to competitive pressures reducing sales prices, but this was more than compensated for by the increase in sales volume. So it's not just saying profit is up by 10%, it's actually explaining the numbers behind it, the drivers, the interrelationship with costs, etc. So you can see why this is a great disclosure. Another example, on the left-hand side, sales of models A and B were above expectations. Again, nice. Tell us more. So sales of Model A was slightly up on last year by 2%, which was lower than anticipated by the directors last year. So our expectation was 10%. And remember, these expectations has to align with the assumptions you've made for going concern assessment, for impairment testing, etc. So you can see the link here. Market feedback is that some features of Model A are not as advanced as certain competitor products. We have started an urgent upgrade of Model A, which is discussed in paragraph B of the OFR. And then they talk about Model B separately. Sales of Model B will up on last year by 20%, which is very encouraging and higher than anticipated last year. Our expectation was 15%. The key reason for this increase was the expansion of our distribution networks, including significant contribution by direct internet sales. So that makes up 30% of Model A's sales, and that's again up 5% from last year. So you can get the idea here. This is not just repeating information that's in the financial report. It's supplementing it, explaining it to the shareholders so they could, it enhances their understanding of why we had certain results, but also enhances their understanding on what they could expect in future. If you look at the financial position, so not just the results, now we look at financial position. Here we look at things that we could touch on, significant changes in assets and liabilities as a result of major business acquisitions or disposals. There could be changes in funding. There could be changes in our dividend strategy. There could be doubts about solvency, uncertainties around going concern. We can highlight qualifications by the auditor, or if there's an emphasis of matter. So we could maybe outline circumstances and maybe explain the concerns underlying the audit opinion. We can also reference to further details in the financial report. Remember, we said earlier, you cannot reference to information outside the financial report, but you can reference to additional details that's within the financial report. Some of the examples that we can include in our discussion on the right-hand side could be unrecognized or undervalued assets. It could be unrecognized exposures that's not required or permitted to be measured under IFRS accounting standards. So maybe material off-balance sheet items, maybe intangible assets, financial instruments. So they're not recognized, but there's some risk around them. They're not recognized according to the accounting standards, but still important to know about them. And then also unusual contractual conditions, for example, contingent revenues. So again, ASIC has included in their guide some examples of the good, the bad, and the ugly. So on the left-hand side, the not so great, the company's net assets increased by whatever million. and compared to last year. I mean, that is really just repeating information that's in the financial report. Again, on the right-hand side, an explanation of why that has happened. It increased by 10% compared to previous year, which is consistent with and largely attributable to the current year's profit after tax. During the year, inventory levels have largely remained comparable with last year, etc., because management is focused on efficient production processes, cost control, and obsolescence. The next paragraph talks about the receivables and the cash flow management. The last paragraph talks about redundancy payments. So again, you can see it's additional information explaining what happened, explained what management have done. So it's not just this is what happened, it's the reasons underpinning those changes. In the next section, we look at business strategies and prospects for future years. So in the previous section, it was looking at historical aspects. We're looking at results for the previous year. We looked at the financial position at balance sheet date. Here we're saying, okay, let's now turn an eye to the future, look at business strategies and prospects for the future. So we're looking at that third bullet point as part of section 299 capital A. And here we say, if you look at future prospects, we would have a look at, you focus on what may significantly affect future performance and future financial position. Section 299 capital A refers to future financial years. So we need to focus on future financial years, not just the next financial year. So if you look at a shorter period, may be appropriate for startups because the brand new business, you know, we don't really know what the next number of years will look like. So maybe a shorter period is appropriate. If it's a well-established business that's been around for a long time, your future outlook would be for a longer period. To me, it's very similar to when we have conversations with the people that work with us. I think as you get older, and I'm now on the older side, I imagine, on the older side, we have some idea what we want to do in 5 years, 10 years, 15 years. And I can articulate that. But when I was younger and I just started my career in a professional services firm, I found it really, really hard to articulate what I'm going to do the next year or two, as opposed to 5, 10 years. I mean, that was just beyond my comprehension in a way. So I think it's similar here for startups and well-established businesses. You will include prior market announcements in your discussions as like a summary of prior market announcements. You will discuss your business objectives, not just what it is, but how you plan to achieve it, and significant factors upon which achievement of those objectives depends. So these are our objectives. This is how we want to achieve it. These are the steps to achieving it. These are the things that will have to happen and that can help us to achieve it, the things that would be obstacles for us to achieve it. So giving a balanced view of what the future might look like. When you look at business strategies, you outline key business strategies, including significant plans that are part of strategies. So maybe the entity's intention to develop or discontinue certain products or services. Maybe we've got plans to enter new markets. Maybe we've got plans to expand production capacity. Maybe we've got plans to expand market share in existing markets. Maybe we've got plans to raise funds for acquisitions. So these are all strategies in play. And in really, Section 299 capital A requires information to make an informed assessment. So you can provide information, you can provide this information at a level without causing unreasonable prejudice to the entity. So you don't have to come out with and we'll look at it later, information that is that sensitive that it is causing unreasonable prejudice to the entity. So it should be unlikely to result in an entity disclosing commercially sensitive information. And then, for example, it is possible to discuss a strategy of discounted pricing without providing the exact amount of discount that will be applied. So we don't want to go out to the market and tell all our customers you can expect a discount of X, but yes, we look at a discounted pricing model. If you look at prospects for future years, your narrative disclosures will be explaining financial performance, financial outcomes that we expect to achieve overall. It will be based on disclosed business strategies, other factors, maybe market, economic environment. Important that the discussion must be balanced. You should also disclose the downside, not just upside. So we must refer to material business risks that could potentially affect us achieving our financial prospects. Material business risks are the most significant areas of uncertainty or exposure at the whole of entity level. You will only discuss those risks that affect financial prospects. So you don't include a generic list of risks that might potentially affect a large number of entities. It has to be risks that would potentially impact your entity's financial performance. So yes, we have to disclose downside, but we should also disclose upside. It has to be balanced. So apologies for that. We'll also disclose factors that could materially improve the financial prospects that we've disclosed. Important to note at the bottom, ASIC does not expect to see numerical financial forecast in the OFR discussion on prospects. So this is it's not a numerical forecast, but it's a discussion of risks, opportunities, strategies, factors that could help us, right? Not a numerical forecast. Then also important, that's recently been added, and this is where it links to the TCFD recommendations, we must include environmental, social, and governance disclosures. So we should discuss whether these ESG risks impact and potentially impact our business, our performance, our outcomes. For each ESG risk that we've identified, describe its context. So why is this risk important? Why could it potentially impact financial performance and prospects? You would include relevant analytical comments. So is this risk expected to increase or decrease in the foreseeable future? And if this risk is in the control of management, how is management controlling or managing this particular risk? So it's not just here are all these risks, how do we manage them? And then ASIC also recommends the TCFD disclosures around climate risk. So in many of our webinars, we've talked about these risks. And then obviously other risks should also be considered and included. For example, digital disruption, new technologies, geopolitical risks, cyber risks. So if we just go back to that, there's a number of risks that we're all aware of that could potentially impact your business, privacy, new privacy requirements, etc. So look at all these risks, which of them could have an impact on your financial performance and position in future, not just identifying them, but how do you manage them? And why would they potentially impact your business? Again, they've included some good, bad, and ugly disclosures around business strategies and prospects for the future. So one of the things they've got is on the left-hand side, the company intends to expand with the market for widgets. We have a number of strategies in mind to achieve this growth. So, really not great, actually quite bad. So on the right-hand side, based on the expected growth in China, as predicted by a number of prominent economic commentators, and the demand for customers for the latest technology, we expect the market for widgets to increase for the next few years. And we have a number of strategies to benefit from this growth, including upgrading Model A, further increasing the sales force, and further reducing manufacturing costs. And you can link to other information in the OFR if you've already touched on that. Again, another example, they say, in reliance on section whatever of the Corps Act, we have not disclosed further information on business strategies and prospects because disclosure of that information is likely to result in unreasonable prejudice to the company. So there's really, they say nothing, completely nothing. So maybe a better approach would be, as discussed elsewhere in the OFR, we have instigated an urgent upgrade of Model A. We've allocated 2.2 million for this upgrade, which will mostly be funded by debt, with the remainder to be funded from retained earnings. We expect the upgrade to be completed in the next 12 months, to be followed by a strong marketing campaign with the intention of re-establishing market share that has been lost over the past year. We are continually considering ways of reducing the company's cost of manufacturing, etc. So you can see there's actually a lot of things this organization can disclose in the OFR about business strategies and future prospects. It's not giving any detailed away. It's giving the stakeholders, the shareholders, some idea what's happening. They can see, management is addressing these risks, managing the risk, trying to explore opportunities. Not enough detail, really. And then at the bottom, maybe an example of where we could use this unreasonable prejudice. In the third paragraph, they said, given both the competitive nature of the tender and the fact that the process is ongoing, we have utilized the exemption in the paragraph of the Corps Act and have not disclosed further details about the possible impact of the potential contract on the company's business strategy and future prospects. So it's not just saying we're just saying nothing about the future. There's a particular part about a particular contract that they're not disclosing the details of for very good reasons. They're still negotiating it. And again, another example that you can have a look at. So the company is subject to a number of risks. The company regularly reviews the possible impact of these risks and seek to minimize the impact. I mean, that is just good corporate governance. They're not really saying anything. On the right-hand side, the better example, the material business risk faced by the company that are likely to have an effect on the financial prospects of the company, disclosed in paragraph X of the OFR, and how the company manages these risks include the following. So we've got foreign exchange risk. This is how we manage it. We've got technological obsolescence. This is how we manage it. We've got a reduction in demand from China. This is how we manage it. We've got expansion of production capacity. This is how we manage it. So clear information. Coming back to the ASIC focus areas. So you'll see in a previous webinar, we talked about the ASIC focus areas for 30 June 2024. And there's a link to our article on our website. One of the focus areas of ASIC is disclosures in the OFR. And here they've articulated again a lot of the things we've talked about today. The OFR should complement the financial report and tell the story of how economic market conditions have impacted the business's results and prospects. The overall picture should be clear, understandable, and supported by information that will enable investors to understand the significant factors that affect the entity, its business, the value of its assets. We should explain the underlying drivers of results, financial position, risks, management strategies, future prospects. All significant factors should be included and given appropriate prominence. The most significant risks, business risk of an entity should be included. We should look at ESG risks. So why is the risk important or significant? What's the potential impact of the risk? Where relevant, the factors that are within management's control. Climate change risk could have a material impact on future prospects, and these risks should be disclosed. So they're really making it very clear. We believe climate risk would impact businesses, so you have to consider it, disclose it. They also call out cybersecurity risk in this particular year's focus areas. So climate risk, cybersecurity risk is already called out in their focus areas. If we look at maybe some other feedback, ASIC has issued their latest surveillance report in October 2023. So this is, they've looked at financial reports that's been lodged with them. And they said, these are the things we've seen and potentially creates concern. And these are the key messages for directors and preparers. The OFR disclosures should not be generic, all right, bespoke to the organization, bespoke to the particular year, the economic environment. Management should produce quality and timely financial information. And that would need robust position papers with appropriate analysis, conclusions, and referencings of standards. They say adequate resources, skills, and expertise should be applied to promote quality in reporting. So we need position papers. We need to communicate risks effectively in our OFR, in our reports. So communicate risk affecting information in the financial report effectively and clearly to the auditor, provide timely information to the auditor. There should be a robust process to select the auditor, set the fees, etc. And then at the bottom, they have a link to an information statement around audit quality and the role of directors and audit committees. Directors and audit committees play an incredibly important role in ensuring that we get to appropriate financial reporting and working with the auditors around enhancing audit quality. So in that report, they've given us a bit of an overview of some of the reviews by industry. So you can see a lot of impact reviews around materials, and you can see the light blue is the reviews, the dark blue is surveillance activities, and the black ones are the findings. So a lot of findings around software and services, etc. And on the right-hand side, they give you some information around, closed surveillances, open surveillances, and findings. Can you see there the single biggest area of findings? So that's been concluded, it's an issue, is the operating and financial review. So there's 13 or still ongoing, 13 closed, 1 open, and 19 findings around the OFR, by far the biggest. So you can see there's a clear focus by ASIC on the operating and financial review. Every time ASIC has a finding, they actually issue a media release. And we've got a number of links here if you want to go and look at some of these media releases around the OFR in particular. So there were 6 listed entities increased their material business risk disclosure after ASIC had some findings. 4 listed entities disclosed information about material business risks, which they didn't previously do. The next one, 5 listed entities disclosed information about material business risk again. And then there's also a media release in 23 where 1 listed entity disclosed information about material business risk. So you can have a look at that and what's changed. Important, when we look at listed entities have to disclose material business risks, it's required by the Corps Act. At the bottom, I've said, please note that climate risk is a part of material business risks. Very important that entities look at the TCFD recommendations, that they look at the ASX corporate governance principles, in particular, recommendation 7.4, to get an idea of what they should be disclosing, where they should be doing it, and the attention to detail. And we've got a number of articles that we've published over the last year or so around the operating financial review, so important to have a look at that. If you look at the unreasonable prejudice exemption, so it's important here that we could, have an exemption from disclosing information about business strategies and prospects for future financial years. Before you use it, you have to consider, is there unreasonable prejudice? Is it likely to occur if the information is published? Are consequences on business for publishing the information unreasonable? So it must give a third party a competitive advantage, resulting in a material disadvantage to the entity. So you have to step through each one of those. The regulatory guide in paragraph 70 to 72 provides some more guidance on when is unreasonable prejudice likely. And if you look at confidential information, confidential information may result in unreasonable prejudice if it's commercially sensitive. And you can't say information is confidential if it's already disclosed somewhere else and you don't want to repeat it here. So do be a bit careful about unreasonable prejudice. So how do you decide if information about strategies and prospects for the future can be omitted? You would identify information that shareholders would reasonably require. You would identify and remove, if necessary, the specific parts that would give rise to unreasonable prejudice. Don't automatically assume that all information should be excluded. Maybe some parts, as we've seen in that example, can still be included. Present the information at a level of detail that does not adversely affect the entity. Include information if competitors already have access to that information via other means. And then ASIC's view is that the risk of being found liable for misleading or deceptive forward-looking information is minimal. So if we look at non-IFRS financial information, there's a regulatory guide 230. And really the key thing is financial information that is presented other than in accordance, non-IFRS information is financial information that is presented other than in accordance with relevant accounting standards. So if you provide other financial information and it's not in accordance with accounting standards, this non-IFRS information is not permitted in financial statements. So you cannot have additional subtotals in the statement of profit and loss and other comprehensive income. We cannot have additional columns in the primary financials, etc. You cannot have a separate section below the financial statements that reconciles the information. So non-IFRS financial information is permitted in the director's report, in the OFR, but the line items must be consistent from period to period. And we've given you some examples of non-IFRS information in financial reports, and there's some indication of what can be included and which parts would likely contravene the Corps Act if it is included. We have some discussion around the use of non-IFRS profit subtotals in financial statements, and there's a media release explaining this in greater detail. So non-IFRS subtotals cannot be more prominent than IFRS subtotals, so it shouldn't be in bold. So if you've got earnings before depreciation, amortization, no, can't have that. However, if you've got earnings before interest and tax, you've got operating profit, you've got operating results, that's okay, right? So it's a fine line. And again, there's some guidelines on what can be included and what should be avoided. I do apologize for going a little bit over time, a full 5 minutes. How BDO can help. We can help with IFRS and corporate reporting, big team, number of partners, and then around sustainability. Of course, we can also help with sustainability, and these are the people you can contact. I would like to say thank you very much for joining me this month. I hope you found this really useful. I know everybody's struggling with the OFR at the moment, so hopefully this can give you some guidance. Thank you very much.